In 1956, a 25-year-old from Omaha quietly starts an investment partnership with just over $105,000 and almost no name. His name is Warren Buffett, and only 7 of every $100 inside that first fund are actually his own. He charges his investors no management fee at all unless he first beats the stock market by a wide margin. If he does win, he keeps a quarter of every gain above 6% and nothing whatsoever below it. By 1962, just 6 years later, that small partnership has quietly grown to be worth over $7 million. Buffett's own personal stake has crossed $1 million, and he's still only 31 years old at the time. His strategy is simple and unglamorous. He buys cheap, ugly, forgotten little companies that the market has completely thrown away. His teacher, the legendary Benjamin Graham, had a nickname for these beaten-down, unwanted stocks. He called them cigar-butts. The idea is to grab one last free puff of value from a soggy cigar somebody else tossed on the street. His first real test of this idea is a small dying windmill company tucked away in rural Nebraska. In 1961, Buffett takes full control of Dempster Mill, paying about $1.2 million for the struggling little manufacturer. He pays far less than the company's own assets are worth, but it is quietly bleeding cash every single month. Buffett brings in a ruthless new manager who slashes the bloated inventory, cuts costs hard, and stops the bleeding. Within just 2 years, he sells Dempster Mill for roughly $2.3 million, nearly doubling the money he put in. On paper, it is a clear win, but the fight had been brutal, and the entire town had turned against him. Sitting alone afterward, Buffett quietly decides that buying something just because it is cheap is not always actually worth it. A truly great business, he realizes, will beat a merely cheap one over the long run almost every single time. That one quiet shift in thinking will, decades later, end up being worth tens of billions of dollars to him. And the lesson that finally proves it arrives, of all unlikely places, inside a small California candy store. In 1972, Buffett pays $25 million for See's Candies, by far the most he has ever paid for a business. The little chocolate company earns only about $4 million a year, so on paper, he is overpaying badly. But See's can quietly raise its prices a little every single year, and its loyal customers never once flinch. Buffett gives this rare and powerful kind of pricing power a now famous name. He calls it an economic moat. Over the following decades, that one candy store quietly sends him back more than $2 billion in pure profit. All of it flowing from a single one-time purchase price of just $25 million paid only once. From that moment on, Buffett stops picking up cheap cigar butts and starts hunting truly wonderful businesses at fair prices. His next great bargain is hiding in plain sight inside the chaos of a crashing 1970s newsroom. In 1973, the stock market is crashing hard, fear is everywhere, and good companies are being thrown out with the bad. The Washington Post is one of the most powerful and respected newspapers in all of America at this time. Yet panicked investors have pushed its price so low that the entire company is valued at just $80 million. Buffett carefully calculates that the underlying business is actually worth somewhere around $400 million, 5 times the price. In other words, the market is offering him a full dollar of real value for only about 20 cents. He buys roughly 10% of the whole company for about $10 million, while critics call print media dead. Then Buffett does the hardest thing in all of investing. He simply holds on and holds and holds. Decades later, that single $10 million newspaper stake has grown to be worth well over $1 billion. Once again, he had simply bought a wonderful business at the precise moment of maximum fear and panic. His next bet is even bolder and far riskier, because this time the company he wants is nearly bankrupt. In 1976, the giant car insurer GEICO is teetering right on the very edge of total collapse. Its stock has utterly imploded, crashing from around $61 per share all the way down to about $2. Almost every investor on Wall Street is now completely convinced that GEICO is heading straight to zero. But Buffett had carefully studied GEICO back when he was just a 20-year-old student, and he never forgot it. Where everyone else sees a broken, dying company, he instead sees a fundamentally great business with a fixable problem. He invests about $4 million right as the stock is scraping along the very bottom, then keeps buying more. GEICO slowly recovers, its profits steadily climb, and Buffett patiently adds to his position year after year. Finally, in 1996, Buffett buys the entire company outright, taking complete ownership of the insurer everyone had given up on. Today, GEICO earns his company, Berkshire Hathaway, billions of dollars in profit every single year like a cash machine. A stock that nearly everyone had left for dead at $2 quietly became one of his greatest victories. But his single most famous and most quoted investment of all time is still waiting just ahead of him. In 1988, Buffett suddenly starts buying shares of Coca-Cola on an enormous, almost shocking scale. He spends roughly $1 billion on the soda maker, by far the biggest single bet of his life at that point. That one position alone is more than a full quarter of Berkshire's entire stock portfolio at the time. Plenty of people think he has finally lost his mind paying such a rich price for a simple soda company. But Coca-Cola sells well over 1 billion drinks every single day in almost every country on the entire planet. Its brand is a deep, wide economic moat that no rival company on earth has ever been able to cross. Buffett famously says his favorite holding period is forever, and true to his word, he never sells a single share. Over the years, that $1 billion stake quietly grows to be worth well over $25 billion, and on top of all that, it pays him hundreds of millions of dollars in dividends every single year. For 50 long years, Buffett stubbornly refuses to touch one entire category of company, technology stocks. Then, at 86 years old, the world's most patient investor finally turns around and breaks his own oldest rule. In 2016, Buffett stuns Wall Street by quietly starting to buy enormous amounts of a technology company called Apple. He no longer sees Apple as merely a maker of phones and gadgets that he cannot possibly understand. Instead, he sees a beloved consumer brand with a moat so strong that people would simply never give it up. Berkshire pours roughly $36 billion into Apple, building the largest single position the company has ever held. By the year 2023, that single Apple stake has ballooned to be worth more than $170 billion. It becomes, by a wide margin, the single most profitable investment in his entire 7-decade career. It all traces back to that $105,000 scraped together in a small spare room in Omaha back in 1956, which slowly, patiently compounded into a staggering personal fortune of more than $130 billion. He never traded fast, he never chased a single hot trend, and he never tried to time the market. He simply bought wonderful businesses at fair prices, and then he refused for decades to ever sell them. So what can an ordinary investor actually steal from a 7-decade record like this one? First, a wonderful business bought at a fair price will beat a mediocre business bought cheap almost every time. Second, the very best time to buy is usually the exact moment when everyone else is gripped by fear. Third, once you truly own something great, the hardest and smartest move is often to simply do nothing at all. Buffett built his fortune not from 100 clever trades, but from a small handful of great ones held for decades. He let patience and compounding do the heavy lifting that frantic, restless trading never could. That is how $105,000 and the simple discipline to wait quietly became more than $130 billion.